Good afternoon. Thank you all for joining us here today as we present the multifamily market update. I'm Travis Montgomery, the Director of Marketing here for the Multifamily Investment Advisors team over at Keller Williams Commercial and Keller Williams One Chicago, where in 2020 we've secured over $404 billion in sales volume, or as I like to say, over $1 billion a day in 2020. And we were able to do that by having access to long-term clients and investors through our global powerhouse. Once again, that being Keller Williams One Chicago and Keller Williams Commercial. We're going to start this webinar off by passing it to Drew Heitzman, our Director of Market Analytics, just to give an update in that field.
Good afternoon, everyone. This is Drew Heitzman speaking, and I'm going to start off by sharing the chart of the 10-year Treasury. So as we can all see, the yield curve, the 10-year yield has gone down about 6 basis points over the last 5. And one reason for this is because last week a jobs report came in actually weaker than anticipated. It was expected that 671,000 jobs were to be added last month when really the number was 559,000. So due to that kind of disappointing figure, the 10-year has gone down. And then another interesting, not so interesting is gold futures have gone down. Gold is actually a hedge against inflation, so it's possible that inflation fears are not were a little bit overstated, but it's something to keep a lookout for and watch for the 10-year as we move forward the next few months. Thank you, Travis.
Thanks, Drew, for sharing that information. We're also now just going to pass the ball over to Kevin Greer, who's the Assistant Vice President for Bank Financial, to give updates for the market analytics as well.
Oh, can everyone hear me?
Yes.
Oh, okay. Okay, great. Yeah, I actually was just reading an email saying that distress delinquencies are down. And so I think right now that the market is now correcting itself, and with the banks doing the workouts and loan modifications and repositioning of loans, I think the banks' portfolios are starting to stabilize. I know here at Bank Financial, ours is stabilized. We've gotten most of our clients back on track. A lot of them are looking to refinance now. Our clients are, tenants are paying mortgages on time. They're out of the loan modification phase. And especially seeing with the restaurants, they're back on track and picking up business. So that's what I'm currently seeing.
Thanks, Kevin, for that update as well. Just want to introduce our Director of Acquisitions, Vince, just to give them a brief update as to what investors are seeing out there in the market.
It's interesting dynamic here in the Chicago area market. Given some of the volatility we've seen, in the lending field, we still have a lot of consistent aspects that make Chicago a prime destination for investors nationwide. With the average sale price of property in New York being $1 million, the average sale price of property in LA on the other coast over there being $500,000. Chicago average sale price of properties is coming in at just over $300K. That's leaving a lot of meat on the bone for potential investors. In the multifamily space, we're seeing investors benefit from Chicago being one of the only metropolitan areas of large population where over 50% of that population is renters. And a lot of factors guarantee, Travis, that those renters won't become homeowners anytime soon. Now, we can take that for better or for worse. Those factors include, student debt largely in many cases. In many cases, the mobility of just being able to pick up and go work somewhere else. And this is going to be a top landing spot for those transient workers due to the low amount of income renters are typically spending on rent compared to other major metropolitan areas, certainly the top 5 metropolitan areas. Chicago has the lowest percentage of income that these renters are spending. They're under 20%. And that also leaves room for growth with them paying under the norm right here. Strong economics, 36 Fortune 500 companies are making their headquarters here in the Chicago MSE. And, we're seeing a lot of investors communicate with me and the team, telling us acquisition criteria, telling us they're gung-ho on getting in on the Chicago market. It's really been beneficial for me to not only, do good business here with the team, but to gather this data, being with Keller Williams, with us having 6,000 agents locally, 300 market centers nationwide, and kind of pair these properties we're getting with investors nationwide. Is kind of an unparalleled time in that regard. So Chicago is flaming hot in that regard, and a lot of sellers are taking advantage, as well as, those kind of coastal and, out of town entities that want to get in.
Thanks for that information, Vince. Definitely some good information and a lot of great traction we're seeing out there with investors in the market in Chicago. I'd like to pass the ball over now to Jerry Brown. Just see if you can provide us with any updates in your field.
Well, the big thing that everyone's waiting for is the release of the Chicago triennial reassessment. The assessor had projected that by mid-May he would release the new assessments for Rogers Park. That didn't happen. Mid last week, it appeared that they had released some numbers and then they withdrew them. So right now the expectation is that by Wednesday, they should have released the first set of triennial reassessments for Rogers Park. We have a lot of multifamily clients in that area. So as soon as we get that data, we're going to start scrutinizing it to see just what the patterns are in terms of assessment increases. But for Chicago area properties, we are still waiting for that first release of Chicago data.
Gotcha. Definitely waiting for that update there from you, Jerry. Just wanted to pass it over now to Cody, our lead listing broker on the team. Just give us some information as to current owners and current investors. What can they really do to force appreciation in their asset?
Hello, are you able to hear me all right?
Yep, you're coming in clear.
Awesome. A couple of technical issues on my end. However, there are some really fantastic opportunities and ways to force appreciation amongst your multifamily assets as it stands right now. First off, being one of the heaviest promoted opportunities that Chicago has right now, the ADU pilot zones. There's 5 areas scattered around Chicago in which you can apply through a website right here and essentially add an additional space to an existing structure. There are some rules that kind of go along with that, and I'd be happy to dig into those further. If you have any questions on it, give me a shout. But also opportunity zones. Fantastic way to create a tax shelter while also investing in Chicago, while communicating and essentially partnering with the city to make something happen. It's a fantastic way to force appreciation. And last but not least is cell phone towers. It's a fantastic way to add an additional revenue stream to a building. Not every building will apply. However, the cell phone providers are paying top dollar right now for installation of 5G towers where they need them. It does not hurt to check and see if your building or your asset falls within an area where they need additional coverage. They are very friendly long-term leases, essentially, for the space on your roof or on the side of the building. And an additional revenue source would increase not only the value but your cash flow every month too. There, if you have any questions about any of these, please give me a call or an email. I will post my contact information in the chat window.
Thanks, Cody, for sharing that. Definitely, please feel free to reach out to Cody, especially if you want to see if your property qualifies for one of those cell phone towers. We definitely do a little bit of research and digging into that just to see if it would be a great candidate for your asset. Now we're just going to pass the ball over to our Director of Investor Relations, Kelly Rich, just to go over a few investment opportunities that we have with the Multifamily Investment Advisors.
Hi, thanks for the intro, Travis. I've got an update on some investment opportunities with the Multifamily Investment Advisors. First, we got 5228 South Blackstone. This is a rare opportunity to acquire a trophy wealth preservation mixed-use asset in downtown Hyde Park. This 40-unit building has strong long-term retail tenants, including a long-term national tenant in Boston market. Reach out to us for more information on that asset. Next up, in the 100-unit count range, we have a 114-unit size South Side portfolio in Brainerd and Chatham with a low per unit price of less than $60,000 per unit. These combined portfolios offers an opportunity to pick up a critical mass of assets within a few miles of each other with great cash flow from day one. For more information on these, reach out to the Multifamily Investment Advisors at investment@kwcommercial.com or by phone at 312-863-8990. I'll also drop the contact information in the chat box. Thanks. Back to you, Travis.
Thanks, Kelly, for sharing those opportunities. Definitely some great investment legacy opportunities, especially in the downtown Hyde Park market. And as Kelly mentioned, looking to pick up a critical mass, we have that West Chatham portfolio as well as that Brainerd portfolio. Now I'm going to take the time out to pass the ball over to Tony Hardy, our executive director for the team, just to give us some updates.
Awesome. Thanks for sharing that. Really good information. Cody kind of caught me off guard with the cell phone tower thing, but it is an excellent opportunity to force appreciation. We recently traded a building that had a cell phone tower that was paying $2,000 a month for the rooftop space, so a space that you aren't using. You're getting this equivalent of 2 apartments at $1,000 a month for, and what we were able to do, they had a 10-year lease with the cell tower. So we were able to look at that as $24,000 a year in income and cap that out at a 6 cap, which means for that apartment building, $24,000 at a 6 cap is $400,000 in value that long-term lease added to the value of that property. Also, even if you don't want to sell your property, the long-term lease could be sold. There are companies out there specifically that buy cell phone tower leases from buildings that have them installed. So definitely reach out to Cody. He's got some connections if you're interested in adding value through the ADU pilot zone, cell phone towers, or other ways that he can help you to figure out how to add value to your asset. Real quick, we got a few minutes left. I want to do a quick screen share here and talk a little bit about what we're seeing in the Chicagoland market. Is my screen coming through okay?
Yes.
Awesome. Over the past year, we're 18 and a half months into the pandemic. And initially, we lost a little bit over 400,000 jobs in the city of Chicago. The significant pain for primarily service workers. The recovery has been mostly K-shaped. And when I say K-shaped, you always think of a V-shaped recovery. That's what we're always looking for. The K-shape means that it's been bifurcated. It's been really good for certain segments of the population and horrible for others. And they're going down and the other areas have been trending upward. Now, that was initially. Later on, we're starting to see a little bit more recovery in some of the downtown spaces. the downtown office market, the downtown apartment market really suffered initially. And you got to think 400,000 jobs is what we lost in the whole 2-year period of the Great Recession. So it takes a while to kind of claw back out of that. So far, we've added a significant amount, made up some significant ground, but we're still at a delta of a couple 100,000 jobs. So there's still some pain there. Investors are cautiously optimistic about the new vaccine and us going into, I believe, phase 5, which means more openings and more business being able to get done. Because this whole thing has put a pretty good hamper on our local economy as well as the national economy. But one of the things interesting is how things shook out. The downtown market and some of the core markets initially received a lot of pain as the pandemic started. And some of the non-core markets like the South Side of Chicago started to see increased occupancies and increased demand for the apartment units. And primarily because people were working from home and people were hunkering down, preparing for a significant downturn and kind of pooling their resources. They say, hey, I'm going to be working from home more. I need an office, right? I need an office at home that I can work from. So if I had a 1-bedroom apartment, I need a 2-bedroom apartment. If I had a 2, I needed a 3, so that I can have an office space and a little bit more space. Other things is people started moving in together and kind of consolidating resources. Well, you find the most value on the South Side. Prior to that, the boom on downtown had been shared living spaces or micro units, some of them as small as 350 square feet with 3 or 4 floors of amenities and rooftop deck. And say, hey, you just need your unit to sleep in, but we got all these amenities and we got downtown Chicago as your backyard. Well, of course, that stuff was shut down for months and months on end and weren't so attractive anymore. So we did see a big push toward the suburbs. We saw a mass exodus for some of the office space downtown, looking for smaller office spaces where they could control their narrative a little bit more. Right now, we're getting a few knocks on our doors for a South Loop office building that we have where an owner can come in and take up 18,000 square feet and basically control the building. They don't need to share it with a 100 other tenants, and they can work through it that way. So there was a little bit of a shift in how people use space, right? The restaurants, the venues were closed, and in this K-shape showed a diversion of fortunes or a diversion of a bifurcation, if you will. Downtown and some of the core markets or some of the more expensive markets on the city started giving out big concessions and actually seeing rents go backwards, where we saw increased occupancies and increased demand in parts of the South Side. Another thing that helped was the fact that we had the stimulus roll out within a matter of weeks versus a matter of months before. So that, and it was big, right? Trillions of dollars. Right now, we're into rent assistance that's available from the city and the state. And I think this may be the last day to apply for some. The ADU pilot zones opened up earlier in May, mid-May. And so there's some things to help us out through this. And there's been the paychecks and things like that has helped us through and helped us sustain. So, I mean, we got some good growth on the South Side of Chicago last year. The per unit prices stabilized. The rent, there was moderate rent growth. It was still flat, 1% rent growth, but we saw areas like Lincoln Park, Lakeview, in downtown, rents actually going backwards. So us, or the South Side of Chicago, being able to just remain at par, a little bit above par, was significant. There's always a correlation between occupancy levels and rent growth. And also you're hearing a lot about the demand in single family housing. The single family housing market in Chicago typically complements the multifamily housing market. So as we see single family housing prices rise, we also see demand shift or demand increase and rising prices to a certain extent in multifamily housing. So I know sometimes we think of them being as competing assets. It's just kind of a musical chairs. I do know that in a lot of the properties that we are working on the north side, where the rents are a little bit higher, $2,500, $1,900 in that range, as leases are turning over, a lot of the tenants, a higher percentage of the tenants, I'll say, are opting to go out and buy a house versus to continue to pay that rent. And I think that's another function of the pandemic, where private space inside or green space in your backyard is more valuable. Now, you do hear some chatter out there saying, hey, are we on a bubble? Hey, I just got 17 offers on my property. I got an offer for a single family house that was $17,000 above the list price, or I bid 30, my buyer bid 30,000 above list and still got beat out. Are we gonna melt down? I believe that the fundamentals are there. It's not like where we were in a situation prior where it was really loose lending guidelines. If you had a post, you can get a loan. Lenders and loan companies have been more careful about double checking things. Unless you're a veteran, I haven't seen any legitimate no money down programs. I have seen some bait and switch stuff out there where they say, hey, I got no money down, and you can come and buy some property. If you do have no money down, or you want to buy an apartment from no money down, call one of my competitors. They'll be able to help you out with that. Our properties, you need to come, you need to show up with 20 to 25% to get into the assets. And even if you can do better, that's fine. You need to show us that you have the proof of funds to get into that deal with 20 to 25% down on an investment. There's been transaction volume. 2020 was a low year for transactions. It's one of the first years Chicago was less than $2 billion in the submarket as far as multifamily transaction volume. But we've seen an uptick, and a part of that was because the market slowed down a bit when the lenders put their pencils down, and some of the larger players, like the institutional people, the $60 million plus buyers, really said, hey, when this pandemic started, we're going to hit the pause button. Now, some of the players that they've been beaten out in that space jumped in and said, hey, I finally got an opportunity to buy something, but the lending was a bit slower. And that's evidenced by Frank Martinez on our team, and I collaborated on the deal. 6 multifamily buildings in South Shore that we put under contract May 5th of last year. The deal actually didn't close until February of this year. And it was a lending function where 2 months out of that, lenders weren't lending anymore. They weren't even looking at deals. And it took a little bit more time to get that deal over the finish line. But I will say we did get it over the finish line. We had a good buyer that stuck with the process, was willing to put his money where his mouth is and say, hey, I'll put up a big chunk of non-refundable earnest money to show the seller that even though the lenders aren't lending right now, we're going to stick with this. We're going to figure this out. And we're going to ride this through. And it was real good. It felt real good to finally get after 11 and a half months, that 237 unit South Shore property over the finish line. I'll save some for next week. But just remember, if it's Monday and it's noontime, you'll get your Chicago multifamily market update from the Multifamily Investment Advisors here live. Thank you.
I have a question.
Sure.
Sure. In terms of how lenders are responding to Chicago, there's a lot of different narratives going on. Some say that, because of the uncertainty of property taxes, some lenders are backing away. There are other lenders who are more focused on positive characteristics that, you and your team have been discussing about why it's still a good idea to buy assets in Chicago. What's the lending climate now as compared to pre-COVID?
Well, can I ask?
There's a lender. We got a lender on the call. Look at that.
Okay.
Well, Jerry, actually, that's a good question. From my experience, you know, we still are concerned about, you know, tenants being affected by COVID. So we still ask for what's called a COVID statement, you know, to see if any tenants have been affected by COVID. What was that, that you make an agreement with them? We need to know what that agreement is. Are they back on track, et cetera? However, in terms of moving forward, in regards to your tax question, we look at current and previous taxes. So we can't go off projected taxes and say, oh, well, taxes are going to increase by whatever, 5, 10%. There's no way to factor that in. So we're not concerned with what the assessor is going to do in the future, although we keep an eye on it. So, you know, to answer your question, it's not affecting us currently because we base it on current numbers.
Okay. No, thanks.
And Tony, I think you might be muted.
You're muted, Tony.
Oh, Kevin and Jerry, make sure your information is in the chat. We'll definitely share it with our networks. We do make these accessible on our webpage and on YouTube. If you like what you see, subscribe. That way you'll get an alert when we're coming on, and we'll be able, and you can reach out to us, and we can definitely share this information.
Also,
thanks for tuning in.
Tony, I just came out with a program for veterans. We'll go up to 82.5% loan of value for veterans. So those on your team that are working with veterans, I just put that in the chat. It's an excellent program, and you know, if you have veterans that like to take advantage of it, reach out to me.
And I suppose 82.5% as opposed to 80% or 75%, or
correct.
What's the
for
bit?
veterans,
Okay.
right? So we go 82.5% loan of value. So give them a little boost there.
And there's no limit there as far as long as the debt coverage ratios and things like that are in line.
Correct.
Everything else has to be property.
Correct. Everything else will have to be in line.
And what about if I think that the stock on veterans just went up. So if I'm buying a multifamily deal and I got a veteran on my team as one of the investors, we could potentially qualify
correct.
for that program.
Right.
And need to bring less equity to the deal.
There you go.
Cody, I think Cody's a veteran. He used to fix airplanes in the Air Force. Cody, maybe we can partner up on the next deal.
Yeah, absolutely. That's correct. The Air Force and C-130 was my aircraft, if we're familiar.
Awesome. Thank you for your service.
Look at that. Cody's phone's gonna be bringing off the hook. All right. Thanks, guys, for tuning in. This was a great conversation. Look forward to seeing you again next week. Bye now.
Thanks, guys.
Bye.
Bye.